Okay, good morning, everybody. I'd like to call the January Finance Committee meeting to order, please. And I understand there are no public speakers this morning. Is that correct, Doug?
That's correct.
Okay, so then the first order of business is the approval of our minutes of our December 14th, 09 board meeting. May I please have a motion?
Motion made.
And a second, please? Second. And all in favor? Aye. Okay. Approval of minutes, done. Committee work plan.
Mr. Chairman, there is one change. The special 2009 finance report has been moved from December 2009 to this month's work plan. From now on, it's going to run every January.
Just before we go forward, I'm sure everybody here in the room knows Dave Moretti. I've had the privilege of many years working with Dave, in all his years at the Triborough Bridge and Tunnel Authority. I think it's great that he stepped up and understands this MTA, and I look forward to working with him. And thank you, Dave, for taking the role on as acting chairman, acting finance director, and I appreciate it very much. And go ahead.
Thank you very much. You want
Yeah, the first thing we're going to do, we're going to ask the board if you have any proposed issues for Budget Watch that you'd like us to look at. You don't have to think about that right now, but think about it and just get back to us if there's anything you'd like us to look into this year. So that being said, Budget Watch, David Moretti is going to start this, and then he's going to hand it off to me.
Right. Good morning. I'll be splitting Budget Watch this morning with Doug. Where I'd like to start this month's discussion is kind of where we left off last month, which was the board had passed a budget that reacted to the end-of-the-year changes made in the New York State budget. The state budget changes had combined reductions of almost $300 million over the fiscal years 2009 and 2010 MTA budgets. To bring the plan back into balance, a number of actions were taken in 2009 and 10 by the board, with the most significant being policy actions of $176 million, which included the reinstatement of AABB cuts, additional administrative savings, the phase-out of school fare discounts, and paratransit efficiencies and savings. The end result was a 2009 budget which had a balance of $31 million surplus and a 2010 budget which had a surplus of $2 million. Now, this past Tuesday, the state executive budget was released. On an MTA fiscal year basis, the news is not that good. If passed as it is, the MTA's budget for 2010 would be left with a net $104 million reduction in state subsidies. The reduction primarily reflects a further deterioration of tax revenues dedicated to the MTA and does not appear to be a continuation of the state's deficit reduction plan, which they implemented a cut in 2009 of about $143 million. The release of the governor's budget begins the state budget process, and we'll be working with the appropriate state agencies to better understand the issues related to the drop in dedicated taxes and continue to monitor revenues. The proposed reduction in state aid continues to point us in the direction of making every dollar count and that services are efficient and effective. And Doug will take you through the remainder of Budget Watch.
Before you do that, Dave,
Yes.
Could you give us a better explanation of what the governor's budget did and didn't do?
Okay.
When its recommendations to the dedicated taxes, we heard the $100 and some odd million. I know a little bit about the school fares. Is there
Right.
like a short story here?
Well, I mean, the short story is the dedicated taxes, let's go tax by tax. The MTOA fund, when we look at our calendar year budget, we see a drop of about $33 million against what we had in our December plan.
And is this because they're sweeping it, or they think that it's going to be lower, revenue going in is going to be lower?
Well, what we're told is that revenue is going to be lower, but we're right now presently having discussions with the state to try to better understand what all these changes are.
They're not suggesting that they're going to take a piece of that for their own operations. They're basically
No.
saying that it's going to be lower.
That's right.
So that's for the MTOA.
Right. For the petroleum business tax, it's a $39 million downward change.
And again, it's
Same
not
thing.
that they're taking money, it's just they think that the revenue is going to come in much less. So it's all based on assumptions.
That's right.
Are there any decisions that they made which actually took money we received on a subsidy level, not on dedicated taxes, that they've either made cuts to, proposed cuts to, or not?
At this time, we're not aware of any.
So the school fare is the only one?
Well, the school fare went up by $25 million. And,
To $25 million or up by $25 million?
well, it went up to $25 million.
Okay, so they added $19 million.
$19 million, that's correct. And Long Island Bus, through their AMTAP and 18B, netted out another approximately $5 million to the better. So in total, it adds up to about $104 million.
What?
You merged the two? You took the... How much did you assume, I just want to sort of understand this, on the school fares, how much you're assuming zero, right?
Right.
So essentially, them giving back $19 million is a positive for us rather than still saying they still owe us the balance.
Right. I mean, what it adds up to is a total of $25 million for the school fare program.
I'm trying to understand, when you say we're down $104 million.
Right.
So we're really down $124 million, but
Well,
since
we're
they
down
gave
100
us 19, we're taking that
Okay.
as thank you, or are we saying you guys still owe us more money and we're down a lot more?
If you assume that the cut that was taken last year was all against the school fare, okay, the money that I'm sorry, if you assume that there was $6 million left in the school fare last year, then when you add $19 million to it, there's $25 million in school
That's
fare.
not my question. You
Okay.
said there's a $104 million impact to the
that's
governor's
the net.
budget.
That's
That's
the
the
net.
net.
So
So I guess
we're-
I'm
right.
having trouble understanding why we're saying the net is $104 million and not actually higher than that.
Can you add up what we get to the gross, and then we can subtract out the school?
Go ahead, Doug. You
It'd
have
be,
it.
well, it would be 104 plus 25, so it would be roughly 129, 130 million dollars.
Let's just make this
Sure.
sequentially. MTOA is down minus 33.
$33 million.
Growing business is down. What else is down?
All right, in the case of MTOA, it's based on activity and then their projection of what they would like to keep, because they keep like a rolling fund on that.
Well, hold
and they
on.
wanna have-
I just
Yeah.
asked. So they're keeping a portion of the money?
Well, they're not keeping a portion of the money, but what they do is they try to keep reserves, so so they don't want to go down to zero. But they're
Why?
not
It's our
going to
money.
take
What do
the-
they care?
It's our money, but
It's cash because they need it to balance their budget at the end of the year.
well, their intent at this point is not to take that money. Their intent is to leave that in the cash balances because they've always had prudent. Typically, they've always kept
cash
a
management for them
rolling
to
balance.
get to the end
exactly.
of the year, essentially. So they
But-
are actually taking
So
a
the
piece of the
state could
dedicated
have-
funds.
Could have reserves, but we're past that a lot.
Are they increasing the size of their reserve?
Well, the reserve had been down to very, very low numbers from prior years.
Their reserve, not our reserve.
Well, it's a reserve in that account level.
which they sweep at the end of the year to balance their books.
Well, they don't actually. No, they don't do that. That's so that if they do an approach for us, that
Yeah.
they're fairly confident that the money will actually be there.
So when the revenue comes a little bit lower,
Yeah,
they can still
exactly.
meet the appropriation.
That's what the point of that balance is. That's right. And the key-
Can we just keep marching through this?
Sure.
Because I'm still having difficulty getting to 104.
PBT is 39, and that's strictly a reestimate on their part.
Great, okay.
And it's because they're finding that the numbers have come in a little bit lower than the projections that they had been giving us. All right, so we got the 33 and we got the 39. The payroll mobility tax is something they're still looking at because if you recall, they said that some of the shortfall from last year was going into 2010.
It was going to be made up by April. I think
That's
you
right,
said.
but they never really looked at, I don't think, going from 2010 to 2011. So now they're thinking, well, maybe they're going to make it up, but the activity might be a little bit lower, and then some of that might actually go into 2011. They're right now looking at that. But as of last week, this was the estimate they had, and that was $63 million short.
So, so I see minus 135.
Yeah, and then
You add
there's
the school fares into that.
then you net out the AMTAP on the LI bus, which is about $5 million. So that takes you down to around $130 million. And then the school fare is at 25. You take that out, then you're down to 104.
I guess at the end of the day, my only concern is the way we're characterizing this hit, and I would strongly suggest that we characterize this hit to the budget of $135 million. Or actually, check that. I give them some credit for giving up to $25 million, but last year they gave $45 million for school fares. And I understand the difference. I get that to our budget. Since your budget is assuming zero, that it's not a hit. But I think
Right.
that would be unfair because clearly we're going to face with a hole because I know there are many people very, very concerned about the school piece, and it's not something that's going to go away.
Right.
And I strongly suggest when you send testimony to Albany, when we talk about this thing, that in fact the impact is greater than the 104 that you just said.
Yeah, the 104 from our point of view is what we looked at as an impact to our financial plan.
I
in our
understand.
calendar year
There's a distinction, but there's a difference.
Just so everybody knows, in the pre-briefing that Dave and all the fellows had with me, these are very preliminary numbers from the state, okay? We really don't know, and I don't think these things are really tied down very well at this point. They are meeting with them when, next week?
We'll be in this, yeah, we were hoping to meet this past week because it's complicated analysis, and they really want to get a better handle on it, as do we.
So they weren't even ready to meet with our people yet.
Yeah.
So what's going to happen, though, over the next week or so, our people are going to be meeting with their people. We're going to get a better handle on these numbers. And at the February Finance Committee meeting, I hope, isn't that right, Doug, and Dave, we're going to have really much harder numbers now as to where we stand with this whole thing?
That's our hope, yeah.
The way, just help me
Keep in
again.
mind, because February also is when we do the February plan, which is an information item, but at that point we calendarize the budget, so we'll want to have a much better handle on not only the amount of the tax, but how that would flow out through the course of the year. So it's very important what we do in the next week or so on that.
This is very preliminary.
I understand. I don't want to belabor it. I just want to ask one last question. The way these things work is at some point they set an appropriation based on the assumption. So if in fact the assumption is lower than the appropriate and more money comes in, I mean, they've never given it to us, right, at the end of the year. If anything, has there been in years past where money came into the account over and above the appropriation because their estimate was wrong, where the MTA got the money? I think the answer is no, right?
Well, ultimately, the money has gone to the MTA. I mean,
but not in
I
that
don't think-
particular
I
year.
think
They
there
would
have
hold
been
it, build
there
up
have
to the
been
reserve,
instances-
and it impacts the next year's.
yeah, there have been instances where maybe we didn't get it, but that's going back a long ways.
My point being, I understand it's preliminary and you need to work with the state in order to make those assumptions.
Yeah.
But these are different types of assumptions in the MTOA stuff, and we need to be, aggressive in that. Let's make the appropriation that it's there, because they have every incentive to short end the appropriation on that side. It's not just a function of if it's in the account, we're going to give it to you. We think it's going to be I'm going to be the state for a second. If we think X number is going to be in the account, this is what I'm going to appropriate. If they were low, that only benefits the state, because they'll just roll that into next year.
Just a question on the real estate taxes.
Yeah.
We're going to review that. You didn't get to that yet.
No, I didn't get to it yet.
Yeah, we got that later. Well, that's all coming. We're going to do it. The one thing, though, did you tell everybody about the mobility tax, that's now further short?
I didn't get to that yet.
Okay,
Yeah.
so why don't you make the whole report, and then we can open up for all kinds of questions, because
Okay.
this is no good like this. Go ahead. Let's finish.
You all set, Dave? Okay. Yeah, the January Budget Watch is a first close at 2009 actuals when we compare it with the final estimate. And this is only the first step. In February, we'll have better numbers, and in April, we will have the actual final audited numbers. What we have seen is, while the data is very preliminary, what we have seen is it's tracking very close to the final estimate. In the case of passenger revenue, we were transit and B&T were virtually on target. Long Island Railroad was $3.4 million, or 0.7% unfavorable, and Metro North was just slightly $1.7 million favorable. In combination, like I said, they were very close. Expenses, we don't really have any reliable expense data yet, so we prefer not to talk about it. It just would have no meaning. The only thing we do know that debt service costs were slightly favorable. I believe they were about $9 million favorable for the month, and which also corresponds to the estimate against the variance against the final estimate. Sorry. We'll turn to subsidies now. Real estate taxes for the month of December were $31 million, which is $4 million lower than the prior month and $6.8 million below the forecast for the month, and that was primarily due to lower MRT receipts. For the year, real estate taxes of $392 million were $9 million, or 2% unfavorable, again due to lower MRT receipts. Keep in mind that $392 million, when compared with 2008, was $551 million lower. So we're going against estimates when we talk, but if you look at it in the broader context, we're way down from 2008. Payroll, we started talking about the PMT, the payroll mobility tax, and we came in at $844 million, which was $17 million lower than the final estimate. Again, there's all sorts of issues of timing and compliance. We're not really concerned about that variance so much. We want to just get a handle on this tax. And like Commissioner Saul was saying, that's what we'll be talking to the state about. On the upside, the B&T operating surplus transfer was $19 million favorable, primarily due to lower expenses in 2009. Yeah, 18.7. Just, it was expending materials and supplies and maintenance contracts.
I haven't been there in a few weeks. I couldn't.
20 million after a week.
Well, there you go.
Doesn't look good, Dave.
So I should have left early. I guess I should have left earlier.
Does not look good for you, Dave.
Yeah, I mean, so in aggregate, the subsidies are, a little bit low. With other subsidy adjustments, it came in just about flat. We don't know about the expenses, other than the debt service, a little favorable. And the passenger revenue is flat, too. So we'll have better results going forward, but that's what we know at this point.
Okay, so now we would open up for questions. Alan, did he answer your question? Or you?
Well, I guess my question with respect to the real estate taxes, it said it was $551 million
Down from 2008, yeah.
And it came in several $1 million
Well, we had,
in December.
yeah.
Is the projection for next year that it's going to be even worse?
The projection for next year is that,
Say this year.
for 2010, I know, slight increase with a lot of that happening in the back part of the year. So we really didn't expect to see, any big increase in the first part of 2010.
So the projection is that real estate taxes, though, will begin to
Modestly increase in
modestly increase.
the second half of
The number
2010.
that's going to be appropriated to us,
That's not appropriated.
okay, is
Yeah.
actual collection.
Yeah, that's right.
And can we quantify slightly increasing?
Yeah, I have it in here. I'll get it to you. All right, that's all I have. Are there any other questions? The base.
How much do you anticipate collection?
Yeah, that's what I'm going to look up. It's around 500 million, I think.
Okay.
We can get you the answer.
We'll
We'll
give
get
you
you the
Yeah, I'll get you the
Let's
answer.
not hold on. Are there any other questions?
Just
John?
one on the budget watch, since the EMP is becoming such a large part of what we anticipate, can you report on that in budget watch?
Yes.
Makes sense.
Yeah, I put it in Budget Watch, but only just in prose. But we'll do a little table. We'll get that going forward. Yeah,
That's
sure.
a good suggestion.
We were going to do that.
Okay, everybody satisfied so far? And we'll be, at the February meeting, these guys hopefully will have much stronger numbers from the state, and we'll have a much better handle on where we stand. So this is very preliminary. Okay, go ahead.
The next item is Finance Watch, and Pat McCoy will take us through that.
Finance Watch begins on page 11 of your committee book. There's two transactions that we've recently closed on that we want to report on. The first is $363,945,000 of MTA transportation revenue bonds. This is our Series 2010A issue. We held pricing on January 6th and closed on January 13th. These bonds are the federally subsidized Build America bonds, where we receive a 35% subsidy from the Treasury for the life of the bonds. We sold a 2039 maturity with sinking fund installments beginning in 2033, and this transaction resulted in a taxable coupon of 6.668%, but after adjusting for the subsidy, our cost of funds becomes 4.3345%. All in, TIC was 4.439%. J.P. Morgan and Loop Capital were our two senior and special co-senior managers on the transaction, as well as the rest of our syndicate. Any questions on that one? I'll move on to the next.
What was the spread to Treasuries, Pat, on that?
Spread to Treasury was 200 basis points. Thank you. We did estimate a savings relative to tax exempts of approximately 79 basis points, which equates to about $45 million on a present value basis. So that's why we chose the Build America option as opposed to tax exempt bonds there.
Good choice. What was the spread? Do you remember what the spread to Treasuries was on the previous BABS
Right,
transaction?
it was 180 basis points.
So is this the negative outlook that impacted this, or?
Well, a couple dynamics. The negative outlooks were perceived as a credit event by the lead underwriter here at J.P. Morgan, and so that was part of it. The other part of the dynamic is that when we were last in the market with those transportation revenue bonds at 180 basis point spread, we were kind of drawing a hard line there. That's as much as we were willing to go at that point, and we did not print all the bonds that we had intended to. So we didn't take all the proceeds out that we needed at that time. So those were the two dynamics that were at play here. In this instance, we wanted to pull out the full amount of proceeds that we had anticipated. That, together with the negative outlooks, caused the spread to increase. Secondly, at the bottom of the page, we had $150 million TBTA mandatory tender bond that was remarketed. This bond was issued last year with a maturity of January 20th, and so our intent here was to look at the market and see if we had dynamics that were favorable to move the tender out, which is what we did. We moved it out 34 months at a yield of 1.33%. And so this is really a continuation of trying to take advantage of very favorable short-term market rates right now. There's no liquidity on the bond. There's no insurance or anything like that. So as we get closer to that maturity in November of 2012, we can evaluate the market conditions then and either refund it and fix it out, or move it to a new tender date, remarket it. So that's TBTA, and we call that the 2009-A1 bond. We have two transactions that are on the agenda for approval today. These take place. These are described on page 12 of your committee book. $650 million of transportation revenue bonds, 2010B, is teed up pending board approval. This would be likely be a hybrid structure that includes both tax exempts and taxable Build America bonds. What we're hoping to achieve with this in terms of a debt service profile is level debt service across the transportation revenue credit. We've departed from that slightly over the past 18 months with the market upheaval, and given the stability in the market, we'd like to get back to a level debt service picture. So that's why we'll have likely a hybrid structure there. Barclays Capital is up for rotating book running senior manager assignment, and Siebert Branford Schenck is up for a special co-senior assignment on this transaction. Next is a $700 million revenue anticipation note, Series 2010. The proceeds of this would be used for operating and maintenance expenses, not capital. And this is very similar to the note that we did last year in advance of the payroll mobility tax arriving. And those papers are all in the book, and we'll discuss those in detail later. So any other questions? Any questions on Finance Watch? Oh, there's one other thing that's not printed on Finance Watch. I did want to describe the fact that we did execute a fuel hedge consistent with the board action in December authorizing fuel hedging. That account that we've set aside to hedge fuel purchases was up to $73 million, and we hedged that full amount. We locked in a price of $2.05 per gallon. Again, it's the same hedge we did previously, using NYMEX home heating oil as our proxy for the market. There's a very high correlation between that commodity and our ultra-low sulfur diesel. This included a 1.45 cent spread to the counterparty here, which is Merrill Lynch, exactly the same spread as we negotiated with them in the past. So the way this hedge works is it settles on a monthly basis. It's a 1-year hedge with 12 monthly settlements. At the end of each month, we look at the average price over the month, and we either make a payment to Merrill Lynch or we receive a payment depending on that $2.05 level that was set at the market. The point of this is that at least for about half of our fuel need for buses and diesel locomotives, we're locked in at a price of $2.05.
Pat, just two questions. What was the execution date for this?
This was Tuesday, December 22nd. The lock-in rate last year, last year we had a larger amount to hedge. We had $300 million, and so we did 4 separate transactions that equated to $3 a gallon. So we're 95 cents cheaper now.
This was competitively bid?
It was not. No, it was done on a negotiated basis with Merrill Lynch. That was the entity that was approved the last time, and it was just a continuation of that program.
Are we going to be bidding these in the future? I suggest maybe we talk about that.
Sure. Okay.
Okay. Thank you very much.
Next item, we have FTA. We have headquarter reports and information items, and there are 2. First, we have the draft copy of the 9 months ended September 2009 MTA consolidated financial statements. These will be presented later today to the Audit Committee for their approval. Upon the approval of the committee, the statements will be available on the web in the next few days. Are there any questions on those?
I've reviewed it, and I suspect there won't be a problem in audit reviewing, accepting that. So.
Okay.
We had no material findings.
We have also a special report, Finance Department 2009 year-end review. Pat will also make this presentation.
Okay. This report begins on page 19 of your committee book. This was intended to be delivered last month, but with the budget news, we tabled it to this month. I'm on page 21 now, just showing you a quick update of our outstanding portfolio of indebtedness, currently $26.6 billion, with 3/4 of that in fixed-rate mode, $750 million commercial paper, $740 million term rate, which best way to describe that is the Triborough mandatory tender bond that I just described. It's that type of bond. $3.2 billion or 12% in synthetic fixed rate. Those are variable rate bonds with a swap on them. And then $1.8 billion or 7% in unhedged variable rate. Turning the page, you see how that debt is dispersed across our credit profile, with the majority of it being in the transportation revenue credit of $12.2 billion or 43%. Triborough senior and subordinate, shown on the left there, of $6.8 billion and $1.9 billion respectively. We have a small portion of debt outstanding related to Broadway, the certificates of participation there, $401 million. And then down at the bottom, dedicated tax fund bonds of $5.1 million or 18%, and state service contract. I would remind you that the state pays the debt service on the state service contract bonds. That's about $165 million a year that the state pays on that. Service contract bonds, a variety of transit and commuter improvements. This goes back to the original issues were done in the early to mid-90s, I believe. When we did the debt restructuring, there was some capacity freed up, and those proceeds were just used for existing approved transit and commuter, largely the 2000 through 2004 program. Page 23 shows a timeline of 2009 and where our debt issues occurred, the major debt issues occurred in the year relative to the a proxy, which is the revenue bond index, which averaged 5.46% throughout the year. And then you can see where each individual bond deal was priced. I won't go into those details. It's something to take away. Note issues on page 24 describe our the revenue anticipation note with a yield of 0.39%. That was done in July. And then again, our Bridges and Tunnels bond anticipation note of 0.32% done in November. Page 25 describes our participation in the Build America Bonds program. Again, this is a program that at least current congressional authorization extends to the end of this year. This allows us to issue taxable bonds and receive the 35% subsidy for the life of the bonds. Our transactions in 2009, there were 3 of them here described, beginning with our DTF series, 2009C, the Triborough, and lastly the $470 million transportation revenue bond. In each case, we realized substantial savings over a traditional, what we would estimate at that time to be a traditional tax-exempt financing. Page 26 contains a market recap, and I'm not going to go into that. It's a good takeaway for you just to get a sense of the market environment we were in 2009. Page 27 shows our forecasted debt issuance schedule with $2.5 billion coming this year, $1.6 billion in 2011, $2.2 billion in 2012, and $2.5 billion in 2013. And the lumpiness of this just speaks to the difficulty in pinning down the specific cash flow on such a wide range of capital projects. And this is refined and updated with each plan. The RANs are not included in this. This is just bond issuances for existing approved capital projects. It does include transit, commuter, and bridges and tunnels. And then page 29 just has a summary of each transaction, a little more detail on the transaction, the management group, the purpose, the TIC, or true interest cost, and the average life of the issue. And again, I'm not going to go into all those details. They're a good takeaway, and if there's any questions, I'm happy to take those now. I think the average life was what you wanted, right? We got that in there, so, okay.
And I just want to reiterate what Doug said before. This was a report that was supposed to be given in December. We're now moved it to January, and we'd like to permanently keep it in January since it is a year-end report, and if there's no objections, we will do that.
Okay, is everybody satisfied now? Okay, thanks, Pat.
Thank you.
Excellent report.
Thank you. We have 2 action items. The first item is a Series 2010B new money bond issuance authorization, which can be found on page 31. Pat, do you want to talk about that?
Sure. What you have before you is a staff summary describing the need to borrow up to $650 million for existing approved transit and commuter projects. So this is largely for spending in the 5 to 9 capital program. Again, as I described earlier, we're anticipating a hybrid structure that includes tax-exempt bonds, probably in years 2 through 12 or 13. That's about where we see the break-off. It's a moving target, and we're working with our financial advisor, Goldman Sachs, to make sure we pin that break point precisely. After that point, where Build America bonds become more cost-effective, then we'll be issuing Build America bonds. Again, the objective here with respect to structuring is to have a level debt service profile in the transportation revenue credit at the end of the day.
Pat, are you expecting to negotiate the standard fees for sales commissions for this transaction on both the BABs and the tax-exempt side?
That is correct. The method of sale in both cases is negotiated. In both cases, it's a rotation assignment of our existing pool of senior managers. So on the bonds, this is Barclays, and Siebert Branford Schenck is special co-senior manager. And on the note sale, it's assignment of Citigroup with, I believe it's M.R. Beal up as special co-senior. Now on the note sale, because of the nature of that note that we're offering, we're not going to have, it's not recommended to have the full syndicate. It's just to have the 3 senior managers and the special co-senior manager on that.
And is it a 1-year maturity on that note?
It would be a 12/31 maturity, so it would mature this year. So by the time we price it, it'll be 10.5 months to 11-month maturity.
Okay, so you need a motion for this, right, Pat?
For the bond issue, we're taking them one at a time, I guess, right?
You want to do?
Or do you want to do both? However you want.
I don't know, whatever we have. Can we do them together? If we can, let's do them.
So there's
together.
2 staff summaries. Again, $650 million of bonds for capital and $700 million of notes for operating expenses, largely to deal with timing of receipt of state dedicated subsidies.
If there's no objection, we just take one. Okay. So may we please have a motion to approve the sales? And a second, please. All in favor? Okay, go to market.
Thank you.
Okay, next we have one competitive procurement for HQ in the amount of $130,000 for the design, fabrication, and delivery of laminated glass panels at New York City Transit's Mott Avenue Station.
And a second, please.
No, it's for transit project.
Yeah, it's our for transit, which that's under HQ.
Okay, motion's been made. A second, please. Please. And thank you. Okay, and a vote, please. Okay, next.
Okay, we're going to move to the agency sections now. Metro North, there are no items. Long Island Railroad, there are no items.
See, when we said stop spending money, what's happened to you now? It's so simple. Nobody's spending any money.
I'll keep going that way. LI Bus, there are no items. B&T, there are no items. Transit, we have 3 separate items. We have 2 competitive procurements. One is G&K Services for the supply and distribution of uniform garments, and that's it's a multi-agency procurement with Transit, MTA Bus, and Long Island Railroad, totaling $29 million. You want to do it all at once? Or?
Yeah, we can do it all at once.
Okay. The other competitive is Verizon Network Integration Corp., which is on page 91 in the amount of $7,748,000. And that's the modification of an existing contract for the maintenance of Cisco hardware and software to cover additional devices that will be needed for a lot of communication type work.
Okay. So we need a motion, please, for these 2 procurements?
I just want to note on that third, are we on the track?
We didn't get to the third one.
No,
Okay.
no, we're going to get to that
Okay.
one separately. Okay, so we have a motion on these 2, the Verizon and the, what was the other one? Lion uniform. Yes. A motion, please. A second, please. All in favor? So done.
There's a procurement for track engineering that was modified from what you see in the book at the Transit Committee. What was a $1,369,000 contract has been changed to $897,149 as only the maintenance portion of the contract was approved, and that's what we're recommending for Finance Committee as well.
All right, so we need a motion, please. And a vote, please. Done.
Okay, next on the agenda is MTA Bus, and there were no items. Capital Construction, there were 3 non-competitive procurements totaling $4,888,592. 3 in total. They sum up to $4.9 million.
Yeah, I had asked for some more detail on this 5-Star Electric and what's involved in this. I think it's okay if we move this here now.
Okay.
But we're supposed to be getting, Dave, I know you're going to get it prior to the board meeting. I want to just take a look at this thing because I didn't have a chance to look at it. But if it's okay, I would like to move it, and then we'll review it prior to the board meeting. Okay, a motion, please? Motion. A second, please? All in favor? Aye. Okay. Dave, you'll get me that information, right?
Next up is MTA Bus. Also, there were no items. No, I'm sorry, I did that already. First Mutual Transportation Assurance Company, there are no items. And that concludes our agenda.
Okay, thank you very much. Very good job, guys, for the first time. And motion to adjourn? First time this year. As a group, first time. And a second, please. All in favor? Thank you very much. We'll see you in February. Excellent. Good job, Doug. Excellent.
Oh, thanks. Appreciate it, Andrew.